Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome along to the latest episode of the ASB Investment Podcast. I'm your host, Nigel Grant, and today I'm joined once again by my right-hand man here at ASB. He loves these intros. We haven't had him on for the last few shows, and I can tell today he's rearing to go. He's like an economy emerging from 2 years of recession, ready to rorts. Mr. John Smith, how are you, John?
You're the master of hyperbole.
And
Absolutely. I'm very well, thank you, Nigel.
I just do it to irritate you. And our other guest today is one of my other ASB colleagues. It's her first time on the show. It's Emily Huang, who is one of our leading executive wealth managers who works with clients and their wealth needs every day. How are you, Emily?
I'm very well, thank you, Nigel.
Wonderful, and good to have you here. So, John, we'll go to you first. How's the farm? And I guess as a derivative of that, we've been talking this morning about your adventures into solar.
Yes, no, the farm's good actually. Actually, this is a lovely time of year. Spring, lots of blossoms around. We've got a lot of Japanese cherry blossoms, so it's just really lovely at the moment. Yeah, a bit of an adventure into solar. Panels went on yesterday actually. Bit more of an exercise than I thought it was going to be actually. But yeah, really, really interesting. My mind just loves the whole process. So,
I know it does.
And it was great.
Yeah. And you were saying it's not just about the panels that you thought was the biggest thing. It's actually just they basically have to rewire your entire house.
Yeah, it felt like they were rewiring the whole thing. Yeah, absolutely.
And Emily, so you haven't been on here before, so let's find out a bit more about you and your role. So tell us a little bit more about your role and then also what you like to do in your spare time.
Yeah, so as a wealth manager, I work with my clients really closely, getting to understand their current financial situation and focusing on their future aspirations, what's important to them. And I then help them to build a solid financial plan to drive towards that financial goal.
Sure.
Yeah. So,
and outside of work?
Yeah, outside of work, my life evolves around my two daughters.
Yes, like it should.
Yeah. So both of them, one is a competitive gymnast, and the other one is a competitive dancing. So you can imagine all those travel times, training times, competition. Pretty much being a full-time supporter is my other job.
Well, I've got an almost 8-year-old, and she's a dancer as well, and so I reflect on my own weekends with one. Yours must be out of control.
Yes, busiest weekends. Yeah,
and you look after clients as well. It's all good. Now, before we get into it, I just want to make a couple of quick points. This podcast is focused a lot on financial advice and sort of why to get it and some certain things that customers are asking us about. So this one doesn't constitute financial advice for your situation or goals. So the intent is to help you navigate for the conversation today the at times overwhelming world of investments and where to start on this journey and bring the concepts to life through real world examples. We just thought it was really important that what's happening in the market and with interest rates that we have this conversation now. But if you'd like to talk to someone at ASB like Emily about your options and who can provide that advice to you, check out our website for more of that info. So with that out of the way, when we were thinking about podcast topics, we noted that with, as I said, interest rates coming down, more people out there might be wondering what options exist? Where do I start? Where do I go? So with that, Emily, what are you seeing at the moment? I guess you're working with customers that are, somewhere on their wealth journey. What are you seeing with them? What are they raising? Or what questions they're coming to you with?
Yeah, we're definitely hearing lots of clients expressing concerns with the drop in interest rates, especially for clients that are looking to build their wealth or towards that retirement future. They feel like the lower interest rate is really putting them behind where they need it to be. And you've got clients that are already in retirement. Now, what we're seeing lots of is they're finding that they actually need more money to live on, comparing to maybe what they were on last year.
Yeah.
So take a recent example of one of my clients, a couple in their 60s. Now, they've been retired for a number of years, so they're well settled into their retirement life already.
Okay, good. And lucky them, good for them.
Yeah, exactly. So that includes sort of spending most of their time in New Zealand, trips to Australia to visit family, and also an annual trip away. So they're really enjoying their lifestyle. Okay. So to be able to do that, they were really comfortable with having that $80,000 a year. Now, sitting down with them this year round, and we sort of re-looked at their figures. Now, to their surprise, that $80,000 is no longer enough.
And just to check, that 80,000 of income for their
Income in
lifestyle,
total.
isn't it? Yeah, sure.
Yes,
Yeah.
absolutely. So there's a bit that's coming from New Zealand Super, and
Yep.
of course they rely on their investment nest egg to actually top up the remaining portion.
Yep.
Yeah, so you've got things like rates, insurances, travel, medical.
Groceries.
Yeah, groceries. I
Yeah.
mean, they don't
Yeah.
seem a lot individually, but when you actually add them up. So after going through these figures with them, they now realise that they actually need $90,000 a year. So that's about a $10,000 increase, and that's not making any changes to their lifestyle. That's not adding anything new. Or
Same
extra.
trips.
Same
Yeah.
trips.
Yeah.
Everything remains the same. But that's about a 12% increase, which
Yeah.
is quite different to the CPI we were talking about, right?
Yeah.
Yeah.
And just to check before I go to you, John, just so they've found that out through a conversation or a meeting with you. Is that correct?
Yes, absolutely. They've been on this investment journey for about last 5 years now.
Yeah.
So they were growing their investment for a while before sort of starting to draw from their investment nest
Yep.
egg about 2 years ago.
Yep.
But that $80,000 a year, it's something that we've actually worked through over the last few years.
Oh, wonderful.
Yeah.
So you've coached them and helped them on that.
Yes.
Okay.
Yes.
And John, so does that example resonate with what we've talked about over the years on other podcasts as well, the impact of what's happening to money?
Yeah, look, the sort of concepts that I think about when I hear that story is really important to understand the impact of inflation on assets and the need to have a mix of assets, right? So if I just start with a really basic premise, let's say when we get to retirement, when people are in retirement and they're relying on their assets, they want to make them safe. So there's a really natural inclination to put it all in term deposits. If you put it all in term deposits, then say you've got $1 million, and maybe these people have, so maybe you're earning $40,000 off that, a 4% rate. In 10 years' time, it's still going to be producing you $40,000. But with
Which
inflation,
on the surface sounds right.
Yeah,
Good.
that's right. But with inflation, I mean, actually, even just 2% inflation, it needs to be $48,000 to fund the same lifestyle.
Yeah.
Right. So
The same lifestyle.
the
isn't it?
same lifestyle, not a
that's
growing
critical point.
lifestyle, right? So the customers first, they need to think about continue to increase the amount they draw so they can maintain their lifestyle. That's something that they should plan to do, and they should plan their portfolio so that actually has the right mix of assets so that it will grow and maintain their lifestyle. So if you think, for example, you take that $1 million, and instead of having $1 million in deposits, let's say have $600,000 in deposits, $400,000 in shares. Okay, now shares, 4% dividend rate, not unusual. All right, so you're still getting 4%, but now you've got $400,000 in shares. So in 10 years' time, that $400,000 is quite reasonably going to get to $600,000, right? Just 5% per annum is going to get to $600,000. That's $1.2 million. $1.2 million at 4% is $48,000, which is pretty much what inflation, what you need to sort of like maintain the lifestyle. So you need to make sure you've got the right mix of assets to maintain your lifestyle, and then you need to plan the way you draw the money from your assets so that you maintain your lifestyle, so you're increasing it every year, right?
Sure.
So that was where I got to when I heard that example.
And I guess what was a catalyst for this conversation is interest rates have been going one way for quite some time. Now they're going the other. Slowly, we don't know how fast it's going to go down. There's varying guesses on that. But this has a profound effect on those that live off the interest of those savings. Income down, as we've talked about, expenses up, it's not ideal. So, Emily, what should customers be thinking about, I guess, with this situation? What are some of the options that may be more suitable than TDs over the long term?
Yeah, I mean, term deposits and savings account definitely have their place to be, especially for things like emergency fund and short-term needs, such as a trip or maybe home renovations or buy a new car, right? But if you want to see your investment through your retirement years, or if you rely on an income, then you really need to be considering options outside of term deposits. And so incorporating some of those growth assets, like what John said, into your overall wealth is actually a great place to start. So options like a well-diversified managed fund or even KiwiSaver, that gives the investors the opportunity to actually grow their wealth and also to protect their future income stream.
Sure.
Yeah.
And John, sort of, we talked a little bit about, I guess, a managed fund or diversified investments. Is there anything you want to go into there?
So if you take that example that I talked about before, having some deposits and have some equity. So, I mean, what that says to you is, okay, no, now I actually have to manage some equities. I mean, actually, I'm not particularly skilled at that. So what do I do? So that's where the concept of a managed fund is, I think, really
managed
good.
fund.
Managed fund, right? And the other concept which is really, really interesting in here is that often people get caught chasing rates. So inflation's coming along and interest rates start rising, and it's like, as has happened in the last couple of years, all of a sudden you've gone from rates which were below 1% often for TDs up to 6%, and all of a sudden people think, oh, that's great, I'll put it all in TDs. And now when interest rates start going down, they say, no, what do I do now? And so the better answer sometimes is just to have a diversified portfolio which is constructed in a way which is appropriate to your long-term goals, and just stick with that portfolio and then draw this regular amount of income out of it. That's a better course. And then you sort of like get less concerned about the ups and downs of the market, right?
So, Emily, as we've been talking about, with TDs and savings accounts, you kind of know the rate you're going to get. There was the rate chasing we were talking about, but in shares and bonds, whether it's a managed fund, it's important to separate out this sort of a total return component. Part of the capital value can go up and down, but also, there's that yield or dividend that it also pays out as well. So there's two components. How do you educate? For the latter, I guess, when you've got variability of one but potentially not of the other bit, how do you educate and coach customers that's a normal part of that part of your portfolio, and not to panic, when you see variability there?
Yeah.
I know it's not easy.
No, not at all. So experiencing volatility is actually a very normal part of investing. And I think as investors, we really need to understand that. So especially if it's a substantial asset that you rely on for the next 20 years. It's a bit like owning your own home. Now, do we value our house every single day? Probably not, right?
Yeah.
So the value of that property doesn't really matter over the short term. But your home is providing you with comfort and shelter and the enjoyment that you get out of it every single day. So even if it does go through a period of decline, that doesn't really matter, because over time, that asset value will come up and eventually provide more for later on. So take your retirement nest egg as an example. What's different with retirement is now you're responsible for your paycheck and your pay rise.
Okay, so let's explain that. The paycheck concept.
Yeah, so the paycheck, that's kind of the level of income I think we mentioned a little bit earlier, is the level of income that you feel comfortable in living. That's going to provide you with a lifestyle that you can live to the fullest. Not just to get by, but be able to do all the things that you want to do. Now, that paycheck, the whole idea is you determine that paycheck. So you're not relying on what you're going to be paid from your term deposit next week or 6 months later. You don't want your life to be sort of evolved around hostage to that, right? But what you're determining is that pre-check that allows you to do everything that you want to do. The rest of that investment continue to stay in there, and it may go through volatility, but what we know is that over time portfolios recover and it will grow and continue to provide more of that paycheck in inflation-adjusted terms. So just going back to that example of mine, they've been living on that lifestyle for the last few years, being very comfortable with the level of that paycheck they were getting. So that's the $40,000 or $50,000 on top of their New Zealand superannuation.
For the 80.
For the 80. So over time, they're becoming more and more confident. That level of paycheck is now more important than that parcel of nest egg. Because what you're focusing on is the money that you've got to actually spend over the next 12 months.
And enjoy your lifestyle for things like trips, or even like endure and pay the bills that come up, like medical or anything.
Well, I think that the really interesting thing is it's some of it is where you focus, right? So if you say, okay, my paycheck or what I'm going to live off is $80,000, and then you just consistently take $80,000, then the portfolio will go up and down, and you'll consistently be able to take that, rather than actually saying, I will live off the returns of my portfolio. And so then all of a sudden you're exposed to the return and you worry about it going up and down. Actually, it will go up and down through time, so long as you set your paycheck, your lifestyle at a sort of like a stable level, and you take the amount of money that affords that lifestyle on a regular basis, then I mean, it's your lifestyle, which is the thing that's most important to you, not the value of your assets. The value of your assets are basically just funding your lifestyle, but the fact that they go up and down from year to year is less relevant than the fact that you're just getting $80,000 a year and that's your lifestyle, right?
Yeah.
Don't focus upon the asset level or the returns that they're getting.
Absolute return.
In the short term. In the long run, it will actually generate a reasonably stable return. And it'll fund your lifestyle.
And that movement is the price you pay for that return, isn't it?
Yeah, so a lot of that movement comes from the equities, right?
Yes.
And it's the equities which is a really important part of this, right? Because, an equity is a share in a company, and a company grows its profits through time, and that growing of profits through the time is the thing that's protecting the value of your assets, or it's actually protecting the paycheck.
Yes.
It's actually the thing that's giving you the inflationary growth in your paycheck, essentially. The payoff or the trade-off for that is that it's a bit volatile.
Yeah.
Right? So focus upon the paycheck, not the volatility of the asset itself.
And before we get to the last question, we've been discussing it sort of in the lead up to this, I guess listeners and our customers to the 80,000 sort of, scenario, they've experienced the impact on one side, which is costs are going up. So if we look at a power bill, I mean, Mr. Solar here is going to, reduce that heavily. But if we look at a power bill, those have been going up. That impacts your lifestyle, impacts the 80,000. Now you can experience that on one side of the coin being a customer. But we talked about the thing that equities and companies do is
they grow their profits
through raising prices to offset
inflation.
Correct.
Absolutely.
So it does allow you to balance out. And I guess that's part of one of the key rationale or reasons why we own equities is that pricing power.
I mean, absolutely. I mean, I think that the equities are the thing that truly grow the assets through time. And when you're in the retirement space, or where your financial assets are the things that are funding your paycheck, then you need that asset base to be growing through time to at least grow at the same level as inflation, so that essentially your lifestyle can grow at the same level of inflation, right?
Yeah.
And that's sort of a lot of what the whole game that Emily does in terms of working out with customers is actually what is it the lifestyle that you want, what are the assets you have, and just working out those sums. That's the process.
Yeah, and that is the important part. It's around that planning. So you've got things set up, like I mentioned earlier, around emergency fund and short-term needs and your paycheck.
Mm-hmm. Yeah.
And then that way, that's not interrupting with the capital growth that that long-term investment that will continue to go up and down, but also will recover as well. So focus on the planning part of that retirement plan, and then everything will fall into place. Yeah.
And I guess the final question before we wrap up with my favourite recommendations, and before I ask this, I guess I wanted to cover back a lot of the principles we've talked about today are just as applicable if you've got the million that's producing 80,000 of income.
Well, a lot of the 40,000 of income.
Oh, sorry,
after pension.
Yeah, yes. But it's also, but it doesn't. You don't have to have $1 million to take on these principles.
No, you don't.
It can be. So I guess that's one thing I wanted to press on is kind of don't feel like you have to $1 million to set some of these disciplines up. You can have a lot less and set the same things up.
Yes.
And I think that the other interesting point, just to clarify the example I've used a few times in this, which is this mix of, say, deposits and a portfolio of shares. 60% deposits, 40% equities, actually that's a moderate fund. And 40, actually the moderate fund is more diversified. So you don't have to do that yourself. The moderate fund is the same thing. Instead of receiving interest and dividends, that's all coming into the pool, and you just basically redeem enough units a year to make the $80,000 or the $40,000. That example I gave, which is deposits and equities, is probably quite a high effort thing to actually do if you're an individual, right? But you can come to ASB, you can get some advice, you can get a fund, and all of that's done by a whole bunch of professionals. All you need to worry about then is just regularly redeeming units to give you the paycheck that allows you to live your lifestyle.
And one of those professionals is the man on the mic right now. So the final question I wanted before we get to those recommendations, for you both, and I'll go to you, Emily, first. What are some of the key things investors, whether it's starting out or the seasoned professional, what is some of the things that those investors should think about before they meet with someone like you or speak to you? Is there anything what makes a really effective conversation if clients have done before they get to you?
I guess this is kind of like the homework
Yeah,
you're talking about.
Yeah, this is school. This is a school lesson.
Yeah, so most important thing is really understand where they are today. I mean, even jot down some of your expenses. That's a great starting point. You'll be quite surprised how many of my clients that come to me have no idea where their money goes. And so that's reality. And so that's kind of your first step, is really understand where you are financially today. What assets do you own, where you are in terms of your spending, in terms of your income, what your lifestyle have been like over the last few years as well, because that's evidence of how you're living your life. Then really think about the goals that you want to achieve. So what does your desired retirement look like? What are you going to do with all those 40 hours spare every week, right? Think about all those things. It's kind of like an open check that you can put whatever wish you want on it. So
I look forward to that.
Yeah, so think about that. But that's a really great starting point before you sort of sit down with a wealth manager like myself. Yeah. Knowing what you want, and then we can actually work through a lot of those things together in our meetings.
Sure, and I guess it's comforting probably for clients that are meeting with you, for other customers or listeners who maybe they're thinking, I have no idea what goes out. That's a common situation.
Very, very common.
I mean, I've been running the same spreadsheet for 10 years. I'm the exception that maybe proves it all. John, you always remind me, and I guess when thinking about our customers, but also you asked me personally about the importance of knowing what your goal is. So Emily was saying that, but also why do you invest? So from your, pause for dramatic effect, decades of thinking about this stuff, for work or your own self personally, again, what's your advice for someone, thinking about starting that conversation or sitting down with someone like Emily?
I mean, it is really, really important to think about why you're investing. And quite often, I think people just think about investing and they're just about maximizing return. And in actual fact, as you get closer to retirement, and your reference to decades, but rude, wasn't it?
That's right.
Because I'm getting a bit old. But
decades, yes.
But as you get closer to retirement, you shouldn't think about it so much as maximizing your wealth, but it is exactly that. Your financial assets are going to fund a lifestyle. What is the lifestyle you want, and so therefore what is the financial assets you need? The other thing which is really, really important when people come to see you, I'm sure, is that they have some sort of view about what they want to do with the assets at the end of the period. It makes a huge difference whether they want to pass them on to their children, pass some of it on to their children, or actually they want to eat their assets. Because if you are drawing down not just the income off your assets, but the capital off your assets, it makes a massive difference to your ability to fund a lifestyle. Yeah. And so that's a really, really important one. And there's a whole lot of generational differences there. I know that the generation that I am, my parents would always have the attitude that they want to pass the assets to their children because they want to, as we move through the generations, I think that's becoming less the case. But nevertheless, it's a really, really important and highly personal decision. And that's something that I think people need to think about. And it has a huge impact on the lifestyle you can live in retirement.
And that's I want my last check or bill to bounce.
To bounce.
Yeah.
Absolutely.
Thank you both for your time today. Emily, especially for your first time on the show. And I really liked, it was important for us to have some of those client examples, because that's what makes it real. A lot of the stuff that we talk about on this podcast is charts and graphs and what goes up, goes down. But when you hear client situations, I think everyone can relate to that. And to you, John, thank you for your wisdom as always and your expertise that you provide, clients and listeners with, and putting up with me as well. The one final question we always go to wrap things up, I ask this of all our guests. So, Emily, we'll go to you first. What's something that you're reading, watching, or listening to that you can share with listeners?
Okay, so I've just started reading a book called Be Kind to Your Mind by Julia Grace.
Okay.
And this is actually a book I won through a work lucky draw. So
I didn't get a ticket.
No, you didn't. Yeah, so she's actually an award-winning presenter and speaker and a coach as well. And actually my first encounter with Julia Grace was from 2023 when I attended National Young Leaders Day with my daughter, and where she spoke to
high achievers.
Oh, thank you. So where she spoke to hundreds of school children about managing anxiety. And so the way that she described it was we'll get those wobbly days.
Yeah.
And that's one thing that stuck with me since 2023. So wobbly days. But I'm looking for, I've just started reading, so I'm looking forward to learning more about the practical tools and things like that. Who knows? It might come handy trying to deal with the wobbly days in markets, right? So,
yeah. I think that relates a little bit to what we talk about. You only have so many good decisions in one day.
Oh, yes, that's right.
Yeah.
Yes, that's right. So a creature of habit like me does the same thing in the mornings so I can save my good decisions for other things.
Same. My wife says I've had the same breakfast for like the last 10 years. Yeah. And John, we were talking before, you've been listening to a lot about Boeing, is it?
Yes, I have actually. I mean, Boeing's a really interesting company. I mean, Boeing was just an awesome
powerhouse
of commercial aviation, military aviation, and actually space as well. And as you've heard many times on this podcast, I love following things space-wise. So it's really interesting fall from grace of Boeing and how they've gone off the rails. And it's interesting to see whether they can actually recover. They've got a new CEO and they're doing some things that I think. I saw Elon Musk commenting that he's the first CEO in a while that actually goes onto the factory floor and knows how planes are actually being made.
The first Boeing CEO.
Boeing
engineer
CEO in a while, right? It's just really interesting following that particular saga.
My one this week is an oldie but a goodie. I just wanted to do a shout out to Country Calendar. Nice. I caught it on the weekend. It shows you a little bit about my TV watching habits. If I ever do watch TV, it's the news at 6, and then it's Country Calendar. It always comes on, and it's such an easy watch. Yeah. But I thought it was wonderful because these people are high achievers. Like they run 10,000 cow or sheep, and they have a cheese factory, and then they're doing the offcuts of that or going to something else, and then they're doing some sort of charitable thing in their community. It's a wonderful illustration, I thought, of hard work, but also that Kiwi ingenuity and number 8 wire mentality. So if you're ever short of, if you finish your Boeing documentary, then it's 7 o'clock on TV1. So that's all for today, folks. Thank you for taking the time to tune in. I hope you found the information useful and you're a little bit better informed now. If you're unsure of where to start with wealth or investment and the conversations around them, the best place is, I think, just to start. You don't have to know all the investment answers or the questions before you get started, nor the difference between complicated investment words or terms. That's our job. So your job is just to have a think about what you want to achieve, maybe have a think about your incomings and outgoings, and then just start the conversation. So get on the journey with it. Until then, happy investing, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.